Hi everyone, welcome back to my series of consolidations. So today I'm going to talk about post-acquisition and pre-acquisition profits. In my last video, I explained to you how a consolidation financial statement can be prepared. The basics of the preparation. We had to ignore the subsidiaries investment in the parent limited and add line by line all the assets and liabilities. And we saw that it was a 100% acquisition, and the acquisition was exactly whatever it is costing for the net assets, then there is no goodwill. So we will have to study goodwill further, but today we are going to study only post and pre-acquisition profits. So for that, we will see the notes. We will see the notes here. Pre-acquisition and post-acquisition profits. Now, when a company is formed, it is not a subsidiary. It is an independent company. It will become a subsidiary only when another company buy the controlling interest in this company. So the buying company will be called the parent company, and the investee, the company in which the buying company invests, is called the subsidiary. So subsidiaries are acquired, not a subsidiary. Will be an independent company functioning after 2-3 years. Some other company comes and buy the controlling interest and make it subsidiary. So subsidiaries are usually acquired after they have been in business for some time rather than they are incorporated, not on the incorporated date. Not necessarily it is bought on the incorporated date. So after 3-4 years, if you are purchasing a company, then there will be profits, retained earnings. So at the time when you are buying, when P Limited is purchasing S Limited, at the time when it is buying, whatever the retained earnings remains are called pre-acquisition profits. After it acquired, up to the reporting date, whatever the retained earnings are being generated, whatever the profits it earns, the subsidiary earns, are called post-acquisition profits. So why this division is necessary? Because when you are acquiring at that date, whatever the share capital, whatever the share premium, whatever the retained earnings, or remaining in the books of S Limited will form the part of net assets. We total that up for net assets. Net assets means total assets minus liabilities, which is equal to the equity portion. So retained earning is one of the equity portion. So share capital, share premium, and the retained earnings as at the acquisition date forms the equity portion, which is equivalent to net assets. And the net assets we are buying, that means P Limited is buying by paying some amount. In this example also, it is going to pay the same amount. There is no goodwill component in this sum also, because I want to explain goodwill after I explain IFRS 3, because fair values are involved. So I wanted to explain that later. So today we will see the pre-acquisition profits and post-acquisition profits. When the subsidiary is acquired, there will be balances in retained earnings. These are called pre-acquisition profit. This will also become part of the net assets that mean included in the equity. At the same time, if the profits are earned from the date, since the date of acquisition up to the reporting date, are called post-acquisition profits. In consolidation, we take only the post-acquisition profits. P Limited share of post-acquisition profits are taken for consolidated financial statement. Financial position, you will be taking the post-acquisition profit along with the P Limited's retained earnings. There can be other reserves as well. For example, revaluation reserve. That also will be treated in the same way. That we will have an example at a later stage. For the basic learners, it's not necessary. So now we see how we are going to calculate the consolidated retained earnings. What is the consolidated retained earnings? It is the retained earnings of the parent plus the parent share of the subsidiaries post-acquisition retained earnings. So here you can see all of P retains earnings plus P's share of post-acquisition retained earnings of S Limited. That will be the consolidated retained earnings will appear in the consolidated statement of financial position. Other reserves also treated in the same way. If there is any post and pre, you have to distinguish it. So we will see an example now. P acquired 100% of the share capital. I am taking 100% because I don't want to mix up non-controlling interest now. I want to teach that separately, non-controlling interest and goodwill in the coming videos. So I am taking 100%. Number one, 100% is taking. For 200,000, capital of S, 200,000. If you see in the balance sheet of S Limited, when you work out the balance sheet as at the acquisition date, you will see that its net assets also 200,000. So P Limited is paying 200,000 for the net assets of 200,000 of S. There is no goodwill component in this problem as well. Then you will see that share capital and share premium of S Limited will be the same as the acquisition date. Always we take that as same as the acquisition date to simplify the consolidation. But in practice, it won't be like that. Subsidiary may issue rights issues, subsidiary may issue debentures, subsidiary may issue preference shares, parent also may issue. All these things can happen in practice, complicating the consolidation. But for our purpose, we are not going to take any share issues in between. We always assume that share capital, share premium of S Limited as the same as acquisition date. These are assumptions that we are making to simplify the problem. So the balance on retained earnings account of S was 80,000 as at date. So they are giving you at the acquisition date. That is, what is the acquisition date? 1st January 2001. At the acquisition date, the retained earning balance of S is 80,000. So you can calculate the net assets. So we are going to work that out later. Now the statement of financial position of P Limited and S Limited as on 31st December. This is the reporting date on which we are going to consolidate the financial position. So the consolidation date is also 31st December. End of the reporting period. The reporting period is also 31 December. So we will see what are the balances. These are the balances. Property, plant and equipment, investment and is 200,000. Current assets, share capital, share premium, retained earnings. And then current liabilities. Then this balance sheet is given. All this information has been given. Now we have to prepare the consolidated statement of financial position. Now we will see how we are going to prepare. Like last time, we are going to add the net assets and the liabilities line by line. BP group. Now this is a group relationship exists because P has bought the controlling interest of S. So it has become P group. We don't call it P and S. We call it P group. Consolidated statement of financial position as at 31st December. This is not the acquisition date. This is the reporting date after 1 year. Acquisition date was 1st of January 2001. So what we are doing is we are adding line by line. Property, plant and equipment we have added. This is at the end of the period we are adding. Then as usual, the investment in S, that 200,000 that disappears. We are not going to take that because that is replaced by the net assets and assets and liabilities. Current assets we are adding again. It has come. Then the share capital, parent only. Here also we are assuming that acquisition date and the reporting date, there is no change. But anyway, we are taking it as the reporting date. If you see the reporting date, it is 150,000. We are taking the 150,000. Likewise, share premium also 280,000. 280,000 as on report date. Now the retained earnings. Retained earnings has become 530. Parents one is 470. Whereas subsidiaries one is 140. So how we got this 530? Here we are going to split it. The 140, we are splitting it as pre-acquisition and post-acquisition. Pre-acquisition, we know at the date of acquisition, these figures are 30,000, 90,000. This is from the 31st December balance sheet, assuming that share capital and share premium has not been changed on the acquisition date. It is the same. So we had taken that. And 80,000 retained earning as on acquisition date. They have provided this information in the sum. So we have taken the 80,000 coming up to 200,000. This 200,000 P Limited has paid and bought the company. But as at 31st December, the subsidiaries retained earning is 140. So what will be the post-acquisition? 140, out of that 80 goes. 80 is a pre-acquisition. Then from the date of acquisition up to the date of reporting, it has earned 60,000. 140 minus 80. $60,000 it has earned. This is the post-acquisition. This is actually belong to the P Limited to the extent of its share. Because now it is its company. Here in this case, 100%. So 100% belongs to him. Belongs to P. So it is taking 470,000. This is P's retained earning plus the share of subsidiaries retained earning. So it becomes 530. We are taking that 530 here. I hope this will be clear for you. Then the current liabilities, as it is, we are adding up. And the consolidated financial position statement is balancing. So I hope this video, you will like it and you will understand step by step how to prepare consolidated statement of financial position, how to prepare consolidated statement of profit or loss, and statement of changes in equity. All that I'm going to teach in the coming videos. So if you like this video, please subscribe for this. And I will be now exiting. So we will meet again. Until then, goodbye.